Should you strive to reduce your share of that credit card balance, student loan debt, or housing debt, or place your money in a retirement savings account or other investments? It's a question that many people struggle with. Let's talk about the one factor that can help you make a more informed decision. Let's get started. Before we jump right into what can help us make this decision, let's talk about why saving and investing is so important. Getting out of debt is great, but there's a reason we want to do that, and it's because it frees up money for our other financial goals. These two financial actions specifically play crucial roles in securing your financial future and achieving your long-term goals. Saving. Saving is the foundation of financial stability. By setting aside a portion of your income, you create a safety net that allows you to weather unexpected financial storms. Saving allows you to build an emergency fund, which acts as a cushion to cover unforeseen expenses, such as medical emergencies, car repairs, or sudden job loss. We'll talk a little more in depth about emergency funds later in the video. In addition to an emergency fund, saving enables you to plan for your financial goals. Whether it's buying a house, starting a business, pursuing higher education, or enjoying a comfortable retirement, saving sets the stage for achieving these aspirations. By consistently setting aside money, you accumulate the necessary funds to turn your dreams into reality. Investing. While saving lays the groundwork for financial stability, investing takes your financial journey to the next level. Making your money work for you is the goal of investing. By putting your savings into investment vehicles such as stocks, bonds, mutual funds, or real estate, you have the potential to generate wealth over time. One of the significant advantages of investing is the power of compound interest. Compound interest allows your initial investment to grow exponentially as you earn returns not only on your principal, but also on the accumulated interest. Over an extended period, compound interest can significantly boost your investment portfolio and help you achieve your financial goals faster. The stock market, in particular, provides an opportunity to benefit from the growth of companies and the economy as a whole. Historically, stock market investments have shown consistent, long-term growth, outpacing inflation and providing a hedge against the eroding effects of rising prices. By diversifying your investments and staying invested over the long term, you can potentially realize substantial gains. Now that we understand the importance of saving and investing, let's shift our focus to evaluating your debt situation. Taking a close look at your debts is a crucial step in creating a solid financial plan. Assessing your debt. To start, gather all the necessary information about your debts. Make a comprehensive list that includes credit card balances, student loans, car loans, personal loans, and any other outstanding debts you may have. This step will give you a clear overview of your financial obligations. Once you have your list, analyze the interest rates and terms associated with each debt. Interest rates determine the additional costs you pay for borrowing money. High interest debts can quickly accumulate and become burdensome over time. Therefore, it's important to identify which debts carry the highest interest rates. Typically, credit card debt tends to have higher interest rates compared to other forms of borrowing. Due to their revolving nature and the potential of compounding interest, credit card debt can be particularly costly in the long run. So, it is often recommended to set paying off high-interest credit card debt as a top financial priority. By eliminating or reducing high-interest debts, you minimize the interest expenses and free up more money for saving and investing in the future. While evaluating your debts, also consider the terms and conditions of each loan. Some loans may have fixed monthly payments, while others may have variable rates or flexible repayment options. Understanding these concepts can allow you to make more informed choices concerning your debt repayment strategy. In addition to interest rates and terms, it's important to consider any penalties or fees associated with delayed repayment. Emergency funds. Once you have a clear understanding of your debt situation and have started working on a plan to pay off your debts, it's crucial to focus on making sure you have an emergency fund in place. When it comes to emergencies, it's not a matter of if they will happen, but when. Life is full of unexpected events. Having an emergency fund in place ensures that you're prepared to handle situations without falling back on credit cards, loans, or accumulating further debt. The general rule of thumb is to aim for an emergency fund that covers 3 to 6 months worth of living expenses. But with any kind of debt repayment, it's often advised to have at least 1 month's worth of expenses covered so that any other funds may be used toward the debts. Now that we have a solid understanding of saving, investing, evaluating your debt situation, and setting up your emergency fund, let's dive into the important decision of whether to prioritize debt repayment or investing. This can be a little tricky, but by considering this key factor, you can make an informed choice that aligns with your financial goals. Interest rate. One of the most important factors you will consider when trying to make this decision is the interest rate on your debts compared to the potential returns from investments. Interest rates determine both the cost of borrowing money and the growth potential of your investments. Debts erode your financial stability and limit your ability to build wealth. When you compare it to the potential returns you could make with other investments, it can give you an idea on whether you should prioritize paying off the debt or to continue investing. How does this work? Let's say you're considering paying off your credit card or investing in an S&P 500 fund. Your credit card is carrying an interest rate of 20%. In order to beat this, the fund would have to return you at least 21%, not counting inflation, to be a better decision. On average, since its inception, the stock market has returned just around 10% before inflation. So in this case, it would make sense to pay off the card because paying off the card gives you an immediate 20% return. By prioritizing debt repayment, especially high interest debts, you reduce the amount of interest that accrues over time. This can save you a substantial amount of money in the long term, allowing you to become debt-free sooner and freeing up resources for other financial goals. On the other hand, if you were able to buy a house during the post-pandemic times and scored a sub 4% interest rate, it may make more sense to invest in the fund instead of paying off the mortgage, as the market has a higher probability of earning you more than 4%. Keep in mind, the returns on investments are influenced by factors such as market conditions, investment choices, and time horizons. So when considering an investment option, it's important to take a long-term perspective. By staying invested and diversifying your portfolio, you increase your chances of earning positive returns and achieving your financial goals. Balance. So you've looked at the interest rate and assessed how it will affect you by either prioritizing paying off the debt or putting money into investments. But it's important to find a balance between the two. In many cases, it's possible to allocate a portion of your income towards both goals simultaneously. By making consistent debt payments while also contributing to your investments, you can make progress in both areas and work towards a more secure financial future. Remember that everyone's financial situation is different, and there is no one-size-fits-all solution. Some people will live on ramen noodles and water to get out of their debt faster, and some are okay with prioritizing it over time. It's crucial to evaluate your own circumstances, consider your short-term and long-term goals, and determine the strategy that aligns with your priorities. If you're uncertain about the best course of action, consider seeking professional financial advice. A financial advisor can provide personalized guidance based on your specific circumstances, risk tolerance, and goals. They can help you develop a comprehensive plan that balances debt repayment and investment strategies, maximizing your financial potential. So, should you save, invest, or pay off debt? The answer depends on your unique financial situation, interest rates, and personal goals. Remember to evaluate your debts, establish an emergency fund, consider the trade-off between interest rates and investment returns, and seek professional advice when needed. That wraps it up. We hope this video has provided you with valuable insights and helped you make a more informed decision. Don't forget to like this video, subscribe to our channel, and leave any questions or comments you have down below. Thanks so much for watching. We'll see you in the next one.